two things happened. If you hedged, your cost of hedging went up 300%. And if you have 100 million in inventory like we would, your cost went up a lot, hugely. And the public was selling into this rally, big time. Speculation pushed it up, and the CME group with the fly swatter smacking speculation, but distorting the precious metals and the refining market, unlike anything I've seen in 36 years, was what stopped it.
Regarding the run up that we saw at the end of 2025 to like $122 silver, I think was around the peak.
Yep.
What mechanisms of control failed that allowed that to happen? Because I was shocked, so much so that I acted like dumb retail money, and my highest purchase was at $104 silver, and that was an enormous purchase. So
Okay,
I'm licking my wounds here.
Question.
Yeah, what
then,
mechanisms failed that allowed that?
in terms of what enabled it to happen, it was pure speculation. I mean, you had massive speculation going on in the futures market. It's more along the lines of what made it stop. And what made it stop was, as the Bank of International Settlements came out and publicly said, it was a structural phenomenon, it wasn't fundamental. In other words, it was synthetic, it was orchestrated. What do I mean by that? My company hedges every ounce of silver that we have. Typically, we'll have 2 million ounces of silver in our warehouse. In December, it cost roughly $15,000 in a margin account as collateral, just sitting there, to hedge 5,000 ounce contract or to speculate on a 5,000 ounce contract. So if you have 2 million ounces, you can see it's a lot of money in your margin account just to maintain margin for what you have in inventory. Within 5 weeks, it had gone to 54,000, and incrementally raising it by 30-35% each time. If you don't post it, they sell you. That selling on the way up begat more selling, begat more selling, begat more selling. But they came out and they said it's structural because at the very same time that this happened, they raised the margins into the first 2 weeks of January, which is really the dumbest thing you could have done, because the first 2 weeks of the month they're notorious for levered commodity-backed ETFs that need to be rebalanced according to their prospectuses. So the first 2 weeks of the year, you know there's going to be selling, especially when silver went going up, 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 up. They got way out of whack. And so they had to sell in order to get in line with the prospectus requirements. So you had all of the selling on top of the massive 300% increase in margin requirements. You all but guaranteed a collapse in the market. And so what was a speculative frenzy, the CME group said, no, we got to kill the speculators. Speculators came in and just kept buying more contracts by posting more margin. Well, you only needed 15 grand, so if you had 110,000, you could control 5 contracts. That's 25,000 ounces of silver. And that would have cost you about 110,000. It would have cost you, for those same 7 contracts, 378,000. 5 weeks later. If you didn't post it, you're getting sold. So all of the selling just to get in line with margin requirements on top of ETF rebalancing created a watershed event. Now here's the interesting thing. China buys more silver the first quarter of this year than it ever before. Who standing for delivery for 26 million ounces of silver and then takes 39 million off the exchange in February? Who bought 20 billion worth of gold on COMEX? 4.1 million ounces of gold stood for delivery in February as it got literally its head cut off. Price is a tool of misdirection. So it was speculation on the way up, and it was the CME group's mission to kill that. Now, what that did was destroy our industry. And I haven't heard any videos you've done with Tyler, but 2 things happened. If you hedged, your cost of hedging went up 300%. And if you have 100 million in inventory like we would, your cost went up a lot, hugely. And the public was selling into this rally, big time. So the public is selling hugely, more than buying. The price is cratering. And then you have the 2026 allocations that all the mints have to take. So they're just drowning in product, and they're forced to take the Krugerrands, the Maple Leafs, the Eagles, the Philharmonics in 1 ounce, half ounce, quarter ounce, tenth, platinum, silver, plus the deals they got with the private mints. They're hemorrhaging cash, either in margin costs, and if you don't hedge, by the time you send someone a check for what they sold, you're way down because the price has fallen so fast. And then a massive source of liquidity are the refiners. But the refiners have to hedge what they take in. They take in 25 million in silver in various forms. Takes a couple weeks to break it down and refine it. You got to hedge that 25 million. So as the price was going up on what they sold short, they're getting killed. Just on to cover their inventory, they're getting margin called every day just on the price going up. And then they keep raising margin requirements. All the refiners in the United States said, we're out. No more business for months. And so that destroyed a huge swath of liquidity that the smaller coin dealers would deal with. Now they couldn't even off-source their stuff. And the primary distributors were choking on it. And so the premiums fell. I've never seen anything like this, ever. But here's an interesting thing real quick for you and for your listeners. I've done this for years. And this is, you might want to ask your own accountant, but we have a legal opinion from CBIZ, a national accounting firm. So the 30-day wash rule, Sean, only applies to securities.
Oh.
30-day wash rule says that if you sell a stock at a loss, book that loss, you can't buy it back for 31 days. Not the case with precious metals. But custody has to change hands. So that silver that you bought, you would send it back to SD. They'd buy it back from you. And we typically work on a 2% spread. Oh, I didn't know that was sticking out. We work at a 2% spread where you'll send us your metal back. We buy it from you. We ship it back to you for 2% more. Now, you can book that loss and buy it back immediately at a 2% spread legally because it only applies to securities, not to commodities. So you can book that loss and buy it right back. And now the cool thing about it is that you show your accountant the one receipt that you sold your metal. Sean, what'd you do with the proceeds? None of your business, Mr. and Mrs. Accountant. You use the proceeds to buy the same thing back less 2%. You either send us a check for 2% or we send you back 98% of what you sent us. Now you get that metal back paper trail free legally. You could show someone the invoice and the inventory, but you have no requirement to do so. So you sold it, you booked the loss, you buy it right back privately and invisibly unless you needed to show it. It's called the precious metals tax swap. The same thing applies for crypto, which is private property, as the wash rule only applies to securities. So for people who bought stuff at a much higher rate, here's a way for them to, if they have capital gains, they want to offset or carry it forward or even write it $3,000 a year off of regular income. Just as a footnote, a lot of people don't know that, so I wanted to bring it up. But the bottom line is, to your question, speculation pushed it up, and the CME group with the fly swatter smacking speculation, but distorting the precious metals and the refining market, unlike anything I've seen in 36 years, was what stopped it.
Let's just play a couple of these clips from Scott Bessent here real quick, because it's interesting to hear a U.S. Treasury Secretary admit that our dollar, our fiat dollar, used to be backed literally by silver, and in some cases, he said gold.
What are we looking at here? These look exquisite.
Yeah, so these are the displays of our currency over the years. Some of it, like we used to have silver certificates. We used to be backed by silver, sometimes gold. And then in the 70s, we just went to what was called fiat currency, where you didn't have to keep gold or silver in the vault. If any of these are still outstanding, though, the silver or gold for them is the at Fort Knox, waiting for them to be claimed if so needed.
Have you visited Fort Knox?
I haven't. People on my staff has. We're going to the Treasurer's office. The Treasurer has been to Fort Knox, and I am happy to say all gold is present and accounted for. The U.S. has the largest pile of gold in the world, over $1 trillion at current market value.
Okay, so this is a PR stunt to some extent. What's going on here? Why are they having this conversation at all?
Well, it's very interesting. I mean, to say the least, he was wrong about, the gold and silver certificates were delinked from the ability to read, because I have a bunch of gold and silver certificates. I'm going to head to Fort Knox if that's the case.
Yeah.
It's not the case. They're not. You're not able to do that anymore. And but I found it interesting that he acknowledged that. Again, this is a guy that understands gold and silver. He does. It was his largest holding as a hedge fund advisor for Soros, and he gets it. It's ironic. I don't know. I mean, again, part of me wants my head to go straight to the fact that they're going to reintroduce gold as part of the monetary system. Certainly could argue they're doing that in the global south. I just think it's a realization. Maybe, yes, it's a PR stunt. Is there something behind it? Don't know. But I will tell you that he's the one guy that you could sit down with and have a discussion on your channel about all of this stuff, and he would be able to hang with you in every respect because he understands it. I don't know. I just think that, hey, I'm all for keep talking about gold and silver, bring it back slowly into the limelight, and sound money would be the best thing that this country could have. It would be the one thing that would enable us, certainly as it backs the Treasury, which, by the way, is another great reason Judy's idea would work, because it isn't a gold standard. It doesn't inhibit monetary policy. The more foolish you are with monetary policy and stupid you are with fiscal irresponsibility, well, the higher the price of gold goes, which will be to the benefit of the bondholder. So I don't think that they're ever going to re-tie gold to the currency. But certainly gold is, I think it's almost impossible to argue. And he even said something to the extent that gold is kind of coming back into the system one way or the other. It is being somewhat reintegrated into the system.